let's say there's a company, they buy a factory, they finance it with debt. Factory costs $100, finance it with debt. Can you walk me through how that flows to the three statements?
Yeah, so the company buys a factory with $100 in debt.
Yep.
And how much does a factory cost? $100?
Yep.
Okay. So pretty much first thing that you're going to want to do is ultimately you have to go out and buy this factory. So your CapEx is going to go down by 100 because you bought the factory. So your net change in cash is down 100. So cash is down 100 and PP&E is up 100. But you also have to take on this debt. So your debt is going to go up by 100. So then ultimately your net change in cash will be up 100. Your debt or your cash will be up 100, but your debt will also be up 100 on the balance sheet. So the balance
Hmm.
sheet will balance. And that's pretty much all like before year one, we could say. And then, uh, sorry, did you say they sell it at some point?
I haven't said anything about that yet. No.
Okay, so yeah, that's pretty much uh, what would happen if they bought a factory with $100 in debt. Okay.
So you talk about like net cash is down 100 and net cash is up 100. So those two basically cancel out, right?
Uh-huh.
So I
Okay, yeah.
was
So there's no change in cash.
yeah, so I was making more clear. Like so on the cash flow statement, basically your net change in cash is zero
Yeah.
because cash flow for debt financing. And by the way, like you primarily just talked about the changes in the balance sheet, but you should talk about the cash flow statement too. Like I
Okay.
mean, you talked about capex, but like the debt when you raise the debt, there's $100 cash inflow from cash flow from debt financing, which is under the cash flow from financing section, right?
Okay.
So with any of these three statement questions, you want to make sure that you're hitting every single statement to the extent that there are changes on that statement. Now, for this first part of the question, there's no change to the income statement yet. But even
Correct.
then, I would just call out that on the income statement, there's no change
Okay.
because right now we're just talking about capex and capex doesn't hit the income statement.
Uh-huh.
So just like acknowledge it, right? So any of these three statement questions, you always want to do income statement, cash flow statement, balance sheet, income statement, cash flow statement, balance sheet in that order, right?
Okay.
Don't just do balance sheet and then like that's it, right? Does
Uh-huh.
that make sense?
Yeah.
Okay, so that's year zero. So now 1 year passes. Okay, walk me through what happens to your income statement, or not just income statement, but to your financial statements in year one.
Yeah. So how long is this factory going to be depreciated for?
Let's say the useful life is 10 years.
Okay. So the useful life of the factory is 10 years and you bought it for 100. So your depreciation is going to go up by 10. So on the income statement, and then your EBIT, your operating income is going to go down by 10. And then, so your pre-tax income's down 10. And then can I assume a 40% tax rate?
Sure, that's fine.
Okay. So that means your net income is going to go down by six. So net income is down by six. That's going to flow to the top of the cash flow statement. Net income's down six, but you have to
Well, are
add
you
back.
missing anything?
Well, we never said that there was like an interest expense on debt or anything, or we were paying interest yet on that debt.
Do you
So I
think
guess
do you think you can go out and find interest-free debt? And if
no. So I
so,
guess what would the interest rate be on the debt?
okay, let's assume 10%.
Okay, so that means your
Because if you can find interest-free debt, I would like to know where, because I would like to get some.
yeah. So your uh, EBIT's going to be down by 10, and then the interest expense is going to make that go down by another 10. So your pre-tax income is down by 20, and then assuming a 40% tax rate, that means your net income is going to be down by 12. So on the top of the cash flow statement, net income's down 12, but then you have to add back the 10 for your depreciation. So that's going to be down by 2. There's no changes to investing or financing. So then your net change in cash is down 2. So on the balance sheet, your cash is down by 2. Your PP&E is down by 10. So the asset side is going to be down by 12. And then net income.
Is there anything that you would want to ask as
I
follow-up?
guess like I'm not selling this. I guess like under cash flow from investing, like I'm not selling this asset, right?
No, what else though? Anything else that you would potentially want to know?
Uh oh, like are we like is the debt being repaid or not?
Yeah. Okay. Um, let's assume that it's a term loan and the term on the debt is 5 years.
Okay, so that means um
And actually, let me ask this: like, if I said it was term loan versus if I said it was high yield, like, how would that change things on your financial statements?
yeah, well if it's high yield debt, then essentially your interest expense or your interest rate's going to be fixed, while with bank debt it's typically floating.
Yeah, but aside
Uh,
from that, because we already assumed that the interest rate is 10%, right? So I'm not talking
Yeah,
about
I
that.
guess if it's a term loan, you're paying it all back at the end. Or sorry, if it's high yield debt, you're paying it all back at the end. But if it's just like regular bank debt, then you're gonna pay it back like annually or monthly or however kind of that's set up.
Okay, so let's assume it's term loan, like we said, and the term is 5 years. So what happens?
Okay, so that means your debt is going to go your debt would go down by 20 under cash flow from financing. So ultimately, now your net change in cash is going to be down by 22. So your cash is down by 22. We said the depreciation is going to cause PP&E to go down by 10. So on your asset side, that's going to be down by 32. On your liability side, your that debt is going to go down by 20, and then net income is down by 12. So you have down 32 on the asset side. Liabilities to shareholders' equity, you have down 32. So the balance sheet balances. I think I should just like not assume and ask more questions.
Oh yeah, for sure.
Is-
I think, on like you should always, first of all, yeah, don't assume, but also like always assume that there's going to be interest expense, right? Just the same way how you always assume there's going to be taxes, right? Like IRS got to get theirs, right? But also if a lender loans you money, they're going to want interest, because otherwise, why are they loaning you money, right? So that's going back to earlier where you kind of just skip the interest expense. Like, you should never skip that like that. That they will just ding you. Like they probably won't ask you, or they might not ask you the way that I asked you, and like just kind of give you an opportunity to fix that, right? Does that make sense?
Yeah.
But yeah, in general, like don't assume anything, and like the key is to go through every single line item on all three statements that could potentially be relevant, and make sure that if they're intentionally vague about it, you want to make sure that you ask clarifying questions to get to the assumptions that you should be using. Does that make sense?
Yeah.
Hey, if you like this video, click the like button and hit subscribe to get more content like this.